Welcome back, students who are taking financial accounting, and in this series of videos we are working on the assigned homework problems for Chapter 7, the exercises for Group B. Note, accounting is about understanding the concepts and applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you do not understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, either email or telephone an instructor to get help with that understanding. All right, so we are working on E7-38B. And it says here, journalize the following transactions of Baltic, which ends its accounting year to September 30th. All right, so on May 1st, it loaned $16,000 in cash to Steve Franklin on a 1-year 6% note. Okay, so it's creating a note receivable, right? So if it's lending cash, we're crediting cash for $16,000, and that creates a note receivable for, I'm just going to write SF for Steve Franklin, for $16,000. Now, one thing I will note here is that if you are making a journal entry and you're doing the books by hand manually and writing it in a journal, or if your accounting software allows you to make a memo, right? With the accounts receivable, with the note receivable, it's you should put in a description, okay, that details everything. Remember, common journal entries like paying rent or paying bills or having an accounts receivable, because they're common transactions that are readily understood, you don't need to write descriptions. But whenever you have something that's out of the ordinary, like if you buy an asset and you're making that initial depreciation calculation, or you're taking out a mortgage, or like in this case, you're taking out a notes payable, or having a notes receivable, these are uncommon transactions. They're not your normal transactions for the everyday operation of the business. So you should write a description. Okay. Now the textbook shows, and it's the description, record loan supported by a note, and that's fine. However, if I make the description to record, this is what I would actually make: to record note receivable for Steve Franklin, $16,000 at 6% for 1 year. Okay, that would be the description that I would write for the recording of this note receivable. Now, I would write, as long as I get all of the pertinent information, into this. The reason why I'm sort of like stuttering is because notes receivables can be a little bit complicated at times. The point being is that you write all of the all of the information about the terms of the note. Okay. If the interest changes, the number of periods change, or whatever it is, that is as part of that note receivable, make sure that it's all included in the description, so that anyone who goes and looks at the note, they can see all of that information there, and they don't have to go hunting for the actual paperwork for the note receivable, right? They don't need that supporting documentation. Now, that's anyone within the organization. If an auditor comes in, okay, and they look at this journal entry and they see this description, yes, it tells them what this note was about, but yes, they will end up asking for the note receivable in order to verify that that information is correct. Okay, but for the most part, the only people, the majority of people looking at these journal entries will be people within the organization. It makes no sense for them to have to always keep on going back and hunting for that note to see what the terms are when it could be part of the journal entry. So make sure that you write a description for the journal entry for something like that. Okay. All right. That, and of course that was a little bit of an aside to what you had gotten in this particular exercise or in the textbook. I mean, that's what all of this little bit of extra about this description is what actually happens in the real world. So just be aware of that. Right, so on 9/17, it says sold goods to Finlay Corp, receiving a 90-day 10% note for $12,000. Ignore the cost of goods sold. Okay, so let's see here. They're selling goods, right, and receiving a 90-day note for 10% for $12,000. Right, so we're going to create a note receivable. Right, for May 1st, we were lending cash, but in this case here on September 17th, we're not lending cash. What we're doing is instead of having an accounts receivable, we're giving a notes receivable instead, because remember, accounts receivable we expect to get back in 30 days. Okay, but when we create a notes receivable, we're creating that for something that's greater than 30 days. And in this case here, it's a 90-day note at 10%. Also realize that with our accounts receivable, we're not charging interest when we make a sale. But in this case, because we're extending the note, we're extending the credit for 90 days, we're also going to charge interest. So we create ourselves a notes receivable. So I debit a notes receivable, and I'll just call it, I'll write FC for Finlay Corp, in the amount of $12,000. And then I'm going to credit. So what am I doing? I'm selling goods. So I'm going to credit my sales revenue for $12,000. Okay. Now, yes, I would put a description just like I did here. Okay, for Steve Franklin, I would, to record a sale of goods to Finlay Corp, receiving a 90-day 10% note in the amount of $12,000. That would be my description. Okay. But I'm not going to write that all out. I'm just letting you know that I would do the same thing as I did for 5/1 because I'm creating a note at this point in time. Okay, let me draw a line here. Let's see if I can't fit this September 30th one in here. All right, so on 9/30, made a single entry to accrue interest revenue on both notes. Okay. Use a 360-day year for interest computations and round to the nearest dollar. So we're using the ordinary method because we're using 360 days. And it's saying we're making a single entry to accrue interest revenue on both notes. Meaning we could have accrued the interest and made an entry for Steve Franklin, and then we could have made accrued the interest for Finlay and made a separate entry for that. But the two entries are going to be the same, all right? So we could combine them together and just make one entry. Now, to be honest with you, if I only had two accounts like this, I would make two separate entries. Okay, and as part of the description for the Steve Franklin one, I would put to record accrued interest for note receivable Steve Franklin, and then for the second entry I would put to record accrued interest for note receivable for Finlay Corp. Right? But if you're a bank or you're some kind of lending institution, or if you're a big enough business where you have a lot of notes, doing that is just highly repetitive and can lead to inefficiency because it's taking more time, and also brings in the opportunity to create errors. And that's why you would basically just go and do all the interest calculations, then add them up and make the one entry. Okay, but and that's why in this particular problem, they're saying to make a single entry. Well, if it was just 2 accounts, I would just make those 2 entries. It's not that big of a deal. But if I had 10 different entries, then I would seriously consider just doing the math and then making 1 journal entry. So let's do the math for Franklin. All right. Remember, Franklin has a $16,000 note, and it is for 1 year. Oh, sorry, yeah, it's 1 year at 6%, so 0.06. But and it's a 1 year note, and we're using 360 as our ordinary method. And so from May 1st to for, let's see here, hold on one second, 6%. Okay, so it is now September 30th, right? So from on a timeline, here's May 1st, and this here is 9/30. Okay, how many days is this period, right? Look at your calendar, add up all of the days, because some of the days have more than 1 month. You can't just go all of May, June, July, August, September. That's 5 months. Oops, sorry. You can't just say that's 5 months at 30 days is 150. No, that's wrong. Okay. The reason why it's wrong is because a couple of months in there have 31 days. All right. So look at your calendar. Look at how many days in each and every month, and you'll find that there's 152 days during that period of time. All right. So 16,000 times 0.06 times 152 is, come on, pen, there you go, is 145,920, and we're dividing that by 360. And we're rounding to the nearest dollar, so that's 405. Okay, so that's for Franklin is 405. Steve Franklin, the interest is 405. And now let's do Gina Baldwin. Okay, so for Gina Baldwin, that's not Gina Baldwin, Finlay Corp. Gina Baldwin has a problem. So 12,000 times 0.06 times, and again, this is over 360. But how many days are we looking at? We're looking at 9/17 to 9/30. So the number of days during that period of time is 13 days, and it's not 6%, it's 10%. So it's 0.10. So I take 12,000 times 0.1 times 13 is 15,600 over 360. So I divide by 360, and I round to $43. So Finlay Corp is 43. That's 448. Okay. So my journal entry. Go ahead and pause the video to do the math. No, I'm going to do it. No, I don't have to do it. I'm just doing it down here. I'm on 9/30 to make the journal entry. Okay. I'm going to debit my interest receivable for $448, because remember, that's the interest we calculated, but we haven't received it yet. It's still owed to us. So we have an interest receivable account of in which we put the 448, and the opposite side that is to the interest revenue. Okay, because we're accruing that interest. We're doing the calculation. That is revenue we earned during those periods of time. Okay. And so that's a revenue to us, because it's money we're going to get on top of, the loaning those amounts. But it's still owed to us. So the opposite side is the interest receivable, because we'll collect that. Now, when these loans get paid off, okay, remember we'll end up making an opposite entry to our notes receivable to reduce those to 0. We'll make the opposite entry to this interest receivable account, all right, to get that receivable down to 0. And then any additional accrued interest that hasn't hit our books will go into that interest revenue account. And of course, we're going to, all of that coming back in cash. So we'll offset those entries with our cash account by debiting it. All right. Okay, so I hope that made sense. I hope I gave you a little bit extra information about writing the descriptions. That's kind of like important. In the real world, it just helps with doing business and whenever anybody's looking at your books, right? And again, you only have a couple accounts, that's fine in making that accrued interest, but when you have a lot of accounts, you'll have a tendency to make just one entry. Right, so with that said, I'm going to stop the video here, and well, let me see here. I'm at 16 minutes. I have 3 more videos to go. Yeah, 3 more exercises to go. I'm going to pause the video and pick up in the next video with 39B. And if you don't understand something, watch the videos again and feel free to contact an instructor. Okay?